Well, hello and messages event. I'm Joe Brewer and presenting with me today is Jack Bennett, tax consultant here at Oldfield Advisory. Hello, Jack.
Afternoon, Joe.
Yeah, the couple of points to cover. The presentation slides will be available after the event, but please take plenty of notes as the bulk of the content is conveyed verbally. Also, a recording of the event will be available in due course. If anyone has technical issues, please feel free to contact us using the chat function. And we will be having a Q&A session towards the end of the event. So please post your questions in the Q&A box as we go along, and we'll try to answer as many as we can. So we thought it was timely to revisit this subject of employee benefits and tax efficiency, given the current background of higher than usual inflation and pressures that puts on employees by way of increased cost of living. If an employee needs more disposable income, I suppose it's always tempting just to increase their basic wage. However, just an interesting fact is that for many employees, increasing their wage by, say, £100 gives them only £58 in their hand. And that £100 actually costs the employer £114. So the net result is the employee only receives about 50% of the total cost to the employer of that additional wage. So today we are going to be covering the following. Many thanks for all those that have joined us. Great to see so many attendees on this webinar. And we're going to be covering these topics. I'll be just touching on the tax savings of paying, giving employees benefits rather than actually paying them a wage, additional wage. And I'll also go on to talk about some totally tax-free benefits. Jack will touch on some other benefits that are actually taxable, but there's still advantages in going that route, and also some comments on vehicles for employees, which is obviously a frequently asked question. Then we'll summarize, and then there'll be opportunity, as we've said, for a question and answer session at the end. So please keep your questions coming through the event and post them in the Q&A box at the foot of your screen there. So on tax savings, obviously benefits that are allowable tax-free save the full 50% tax cost that we referred to earlier. Also, benefits that are declarable go on a form called a P11D form, and that can save the employee national insurance. There's still income tax to pay and employer national insurance, but there's no employees' national insurance on those benefits. And that saving can be as much as 12%, so that's still very worthwhile. So the outcome of using some or all of these ways of remunerating staff will be more cash in the hands of your employees and also company directors, and often less cost to your company. Also remember, benefits and perks are great for staff retention. You can also use them to incentivize staff by maybe adding benefits when they hit a certain performance target, or maybe a certain number of years service, for example. So firstly, the tax-free benefits. These are benefits that don't have to be declared, so they don't go on the P11D form at all, and therefore they are completely tax-free. First up is phones. So mobile phones. This is one that used to be a taxable benefit, but is now completely tax-free if it's done in the correct way. So provision of a mobile phone to an employee or the cost of any monthly rental, includes private calls paid for by the employer. That's all tax-free, provided the contract is in the name of the employer. Where an employer provides an employee with a computer or a laptop for business purposes, there's an exemption from tax. You only have to demonstrate that there's a business need for the employee to be provided with that computer or laptop, and also that it's key to the performance of their duties. Furthermore, there's a home working allowance that can be paid to employees completely tax-free. That's currently £26 a month, which is not a lot, but it's still worth using that, £26 a month. And that's for anyone that's regularly working from home. It just has to be by agreement with their employer that they're allowed to work at home, and that they are actually regularly working from home. So the length of time working from home is not specified. Trivial benefits. These are non-cash items. It mustn't be cash, it has to be non-cash. So this is things like wine, hampers, gift cards, for example. And there's a limit per gift of £50. That gift can be awarded to the employees totally tax-free under the trivial benefit rules. The key condition is that it can't be a reward for performance or KPIs or work done. There must be another reason to give that gift. Also be aware of the fact that there's a limit of £300 per annum for company directors. That's specified by HMRC, and we recommend you apply that guidance to employees as well. So that's a suggested maximum of 6 £50 gifts per annum. That's what we'd advise. On pension contributions, we recently had a spring budget, the Chancellor announcing the abolition of the pension lifetime allowance charge, and also increased the pension annual allowance to £60,000 per annum. So whilst we can't give financial advice on this webinar today, only tax advice, we can point out this does open up great opportunities to reward employees and also company directors. And that's totally tax and national insurance free. So a contribution into a pension scheme is fully tax deductible for the company. So that saves 25% corporation tax. Or it can be allowable against higher rate tax for the self-employed, but it's up to that limit of £60,000 per tax year. So that's a great opportunity and something that we would definitely promote. Some further tax-free benefits are flu jabs, eye tests, and health checks. These are all tax deductible by your company, and they're also tax-free to directors and employees. So firstly, flu jabs are exempt from tax as long as they're actually paid for directly by the employer. Eye tests are tax-free. There is a little requirement there, and that's just that the employee must use a display screen for at least 1 hour a day to qualify, which shouldn't be hard. There's also an exemption for employers providing medical checkups to their employees, quite an interesting one. The exemption applies for 1 health screening in any tax year, and also 1 medical checkup in any tax year. The next one is quite an interesting one and quite relevant, we're finding, with clients, tax-free loans to employees. So you do not have to report anything to HMRC or pay any tax on an interest-free loan to an employee of less than £10,000. Now, that obviously benefits the employee by saving them the interest on that borrowing. And just a couple of examples of how we've seen that used. In practice, we've seen it used to help employees maybe with a deposit for their first house, or maybe in other situations, we've seen it used to repay a credit card debt. Maybe you've got someone with a credit card debt hanging over them and they're paying 30% interest. You can obviously lend the money from your company to that employee, clear that debt off and thus save them that interest, and that's totally tax-free as long as you don't go over the £10,000. Free lunches. This is another tax-free benefit you can provide to employees. So free or subsidised meals, or a token to actually obtain those meals if it's provided to all employees. So that's the condition there. It has to be available to all of your employees. If that is the case, it's not a taxable benefit to the employee. So that's just another way we can help our employees with cost of living. Another big one is actually electric car charging at work. So if you've got an employee with an electric car, obviously plugging in at work is another great tax-free benefit you can provide for them. But Jack's going to cover that in his section on cars later. So won't steal his thunder, and leave that to Jack. So I'll now hand over to Jack, who's going to tell us about some further employee benefits and also cover off on the tax implications of company cars. Thank you, Jack.
Thanks, Joe. That's great. So as you mentioned, there are a number of benefits that do incur a tax charge for the employee, but actually these benefits can be very influential in both retaining and motivating staff. So it's just a question of looking at the best ways of providing these benefits and being clear on the consequences for both parties, both the employer and the employee. So as Joe's mentioned, when a benefit is taxable, these are usually reported to HMRC each year on a P11D form. The employee will then pay income tax on the value of that benefit provided based on their income tax rate. The company does incur a national insurance charge in the same way as it does with earnings, but the employee won't pay any national insurance like they would with a salary increase. So a few examples to look at. The first one being private health insurance and medical treatment costs. So just as background to this, I think the average cost of private medical insurance in the UK is currently around £1,100 per annum. So as an employer, you could therefore look to provide that private medical insurance to your employees as a benefit in kind. So the employer would pay national insurance contribution of 13.8%, as we've touched on, but the employee would only pay income tax on this amount at their marginal rate. So you might have someone who is a 20% taxpayer, so they'd actually only pay £220 per annum in tax for a benefit that is actually worth £1,100 per annum. So as you can see, it can be very useful in tying in employees and helping to retain them. But it's just very important, as with a number of these benefits, that you get it right in terms of who arranges for the cover and who pays for it, so where it's billed. And the same also applies for private medical treatment. So this might be more of a one-off benefit rather than an ongoing insurance. So it might be a situation where an employee is facing some surgery or something like that, and they're looking at the options of doing it privately. As an employer, you can pay for that, and it will be a benefit to the employee, but it could be significantly less than the actual cost, the tax they'll pay. Obviously, these treatments does exclude the benefits that Joe's already mentioned, so the health checks and that kind of thing. They're all tax-free, as mentioned. Another benefit that can be very beneficial to certain employees is in relation to relocation expenses. So just as a bit of a caveat to that, this can get quite technical in relation to the events surrounding the move and the costs that will qualify. But in principle, if an employee is having to relocate due to their employment, then the business can assist with their relocation expenses. And this would typically be where an employee is having to, say, move house to join your company, or because their normal place of work has changed. And usually there'd be a tax-free allowance where the employee wouldn't incur any benefit in kind tax on a certain level of expenses paid for. This isn't a common benefit, however, so I think it's just really for employers to keep in the back of your mind, make sure you're aware of this provision, and then if you think it might apply on a specific case as it crops up, make sure you get good tax advice at that point in relation to those particular circumstances. Another popular benefit in kind is subscriptions and memberships. And to clarify, this doesn't include professional subscriptions. So any professional subscriptions for accountants or lawyers or things like that, it's not included. The most common example we typically see would be gym membership. So the company pays for and arranges gym membership for some of their employees. And from an employee perspective, they'll, as we've covered before, they'll only pay 20% or 40% usually of the cost of that membership. So they'll pay that in tax instead of paying the full cost personally. So we often see this used as a key perk or benefit of joining a company. So when you're trying to look to attract or even retain talent within your company. Joe mentioned earlier about low interest and interest-free loans of below £10,000. But even if the loan is more than £10,000, this can be actually very beneficial to an employee. So in this example we've got here, we're looking at an employee who is currently paying 40% tax, and the employer has offered to give them a £35,000 interest-free loan. And you can clearly see the impact here. So on the left-hand side, we've got what it would be if that employee was to actually just have that on their mortgage. So £35,000 mortgage at a reasonable rate currently will be about 5%. Over that 20-year term of the mortgage, the employee would pay over £20,000 in interest. So actually that loan would cost them over £55,000. If you look to provide that as an interest-free loan, however, from a company, the income tax on that loan over that 20-year period would only be £3,500 based on the current rates as it is at the moment. So you can see there, quite simply, that by using this alternative, so giving this interest-free loan, the employee is saving around £17,000 over the period of the loan. I would just you do need to make sure, however, that you've thought about it from every angle. So you make sure you've got a robust loan agreement in place. Make sure that the company can sustain cash flow. You may even want to look at taking legal advice, so possibly having a charge on the house or something like that. And the other angle to it is just to look at whether it's actually necessary to have that loan in place for the same length of time. And what I mean by that is, if you looked at the monthly repayments of the mortgage route and actually just put that all against an interest-free loan, the employee would actually clear that £35,000 loan in about 13 years rather than the full 20-year term. So it benefits the employer because they get the money back sooner, and it benefits the employee because they're clearing down their debt quicker. Then moving on to the subject of company cars, and I'm conscious we've discussed this topic a number of times on events, but also conscious that it still remains a very highly discussed topic. We get a lot of questions in relation to this. Now, for those that are newer to our webinars or perhaps need a refresh, when we're looking at company cars and which are the most tax efficient, we usually recommend looking at them in this order. So firstly, you look at your wholly electric cars. So as many will be aware, these have a very low benefit in kind, and with tax-free charging, they can represent quite a significant cost saving for employees. And we'll come on to the charging in more detail in a minute. In reality, though, they don't work for everyone. And so the next best option to consider is commercial vehicles. So thinking of vans or pickups. And again, I don't want to go into, you might say, the fine detail of this, but I would just make the point that it's definitely worth making sure that the vehicle you have it is actually a commercial vehicle for benefit in kind purposes. We see it very regularly where the client has trusted the dealer, they've gone to the dealer, and the dealer has assured them that it's a van or a commercial vehicle for benefit in kind tax, when in reality it isn't. I think it's just important to remember that the dealer isn't a tax expert, they don't know tax law, they don't know tax cases, and they do want to sell the vehicle. But if commercial vehicles are not an option, which again, they don't suit everyone, you then want to look at plug-in hybrid cars. So benefit in kind on those is significantly lower than the petrol or diesel alternatives. And usually you can get basically the same vehicle, just with a different engine. And then finally, if all else fails, you can look at the petrol and diesel options. So just to address some common questions that come up in relation to vehicles and how best to do it. Firstly, is a mild hybrid a good choice, or do we have to get a plug-in hybrid? And really, to get an understanding of this, I think it's important to recognize that a mild hybrid is actually just has an electric motor that supports the petrol or diesel engine, whereas a plug-in hybrid has a electric motor that can actually power the engine. And what that does is it means it reduces the CO2 emissions. And broadly speaking, the lower the CO2 emissions, the cheaper a car is for tax purposes. So if you're wanting to look at a tax efficient option, you really need to look at the plug-in hybrid and not the mild hybrid. From a tax perspective, a mild hybrid is really no different to a standard petrol or diesel vehicle. And then secondly, should I provide company car fuel benefits to my employees? And from our experience, it simply isn't worth it for the vast majority of employees. And to demonstrate this, we have a couple of scenarios here. So employee one is a 40% taxpayer driving a VW Golf, so a fairly standard car, and they travel 15,000 miles per annum, of which 10,000 are private and 5,000 are business. So that's how the mileage is split. The cost of their private mileage each year is £1,500. So that's how much it costs for the private mileage only. The tax they will incur by getting their company fuel provided is actually £3,100. So they're actually losing £1,600 per annum by having that company car fuel benefit. Employee two is similar and a 40% taxpayer driving a Skoda Superb in this example. They travel 25,000 miles per annum, of which 8,000 are private miles and 17,000 are business miles. Now their private mileage fuel cost each year is £1,200, and with a tax liability of £3,500, they're losing £2,300 per annum by using the company car fuel benefit. So again, it's just a question of checking, is it actually working? On the subject of business mileage, I would also just like to highlight that it's very important that employees and directors keep a clear log of business mileage. So that's when they're incurring costs, they're paying for the fuel and then doing business mileage. And make sure you charge that to the company where you can at the appropriate rates. Really, you might say they're actually, if you don't do that, you're losing out on tax-free money. Then turning to electric car charging, I think there's really three separate charging scenarios to consider here. So there's charging at work, charging at home, and charging at public charging stations. Charging at work is the most straightforward. So an employee can charge their electric car at work, and that's not a taxable benefit. As Joe mentioned earlier, the employee doesn't pay any tax on that. Charging at home, however, can be a lot more difficult. So where the employee pays the electricity, the employer can't just reimburse this cost, as that would be actually taxable as earnings for the employee. Where the employee does pay for their own charging at home, they're not reimbursed, and then they use that vehicle for business mileage. Again, it's just a question of making sure the employee then charges the company for the business mileage using the advisory electricity rate. And charging at public charging stations only really works where you provide the employees with charge cards. So these work in a similar way to a voucher. So they can only be used for charging the vehicle at certain charging stations, and you can't use them for other purchases. The final point to highlight in relation to vehicles was salary sacrifice. Now, just stepping back and looking at it very simply, in its simple form, a salary sacrifice scheme is where an employee agrees to reduce their gross salary in return for a non-cash benefit. Now, whilst this was more widely used, there were quite a few changes brought in both in 2017 and in 2021, which reduced the scope of that quite a lot. So that for vehicles now, it only applies to low emission vehicles. And this is typically used when employers don't currently provide company cars, or the employee wishes to make a contribution to upgrade their vehicle. And it can also be an effective way for an employee to fund a second vehicle. But on that, a common myth to clear up: this is not a means by which an employee can purchase their own car. The car remains in the company's name at all times. It's more a way they can access a car. I think it's also important to highlight, however, also that a salary sacrifice scheme is a contractual change, so it changes their employment contract, and it needs to be set up with a proper established scheme. And there are numerous companies that can assist you with implementing that, going over the options, sourcing the vehicle, changing the contract. And just looking at an example of how this might work. On the left-hand side, we've got an employee who doesn't have salary sacrifice. So they're employed, they have a gross salary of £80,000. They pay roughly £25,000 tax and get £55,000 in their pocket. Out of that, they then lease an electric vehicle shown on the right for £6,300, and they're left with £49,000. If they were to do that through salary sacrifice, however, they would sacrifice £6,300 of their gross salary, so their salary has gone down to £73,700. They will get a benefit in kind charge, but because it's an electric vehicle, this is very low. They'll then pay tax, and their net income will be £51,500. But obviously, they've then got the car already. They don't need to then use that to fund the lease. So actually, in this circumstance, you can see there that with a salary sacrifice, this employee will be better off. So hopefully this has helped to spark a few ideas on how to reward your employees tax efficiently. And before we move on to wrap up on Q&As, I just want to touch briefly on our next event. So this will be held on the 16th of May, 2023, with my colleagues Jerry Surtees and Carl Taylor. And they're really going to be exploring shareholder buyouts and methods for achieving this that are both tax efficient and flexible, with key insights into the process to follow, the options that are there to achieve different commercial objectives, and some practical examples of how we've seen this work in practice. So in summary, make sure you're using tax-free benefits where they're relevant. Make sure that any taxable benefits you're providing are being reported where necessary. Make sure you review and take tax advice on company car options prior to the purchase or lease of that vehicle. And make sure you are clear on the benefit in kind percentage that vehicle incurs. So make sure that the employee knows and the employer knows the cost of that vehicle. Avoid fuel benefit for cars. In reality, it doesn't work for most. And ensure that your business mileage is claimed regularly. So moving on to questions, we've had quite a number come in. I don't know, Joe, if you want to make a start with those.
Yeah, thank you, Jack. And thank you for all the questions that are pouring in. Probably won't have time to answer them all, but we'll cover off on the sort of common themes. So there's quite a few questions coming in about employee loans. One is, I'm a company director. Can I give my son an interest-free loan of £50,000 from my company? Jack, do you want to answer that one?
Yeah, so I think it's a good question. But really the answer is no. We're talking about employees here, family, close family. There are different rules that apply to those. So you just have to be careful with persons that are closely connected to the directors. It doesn't work the same way.
Yeah, that's good. So just to get that clear, that it doesn't apply. What we've been saying doesn't apply if it's a close relative of a director. If you were to actually provide a close relative with a loan, you could incur some tax charges, couldn't you, Jack? So we want to avoid that. There is another couple of questions around employee loans that we might be able to cover. Someone asks, what are the limits? The limit of tax-free employee loan is £10,000, but there's no upper limit for an interest-free loan to an employee. Obviously, once it goes over 10,000, the HMRC have an interest rate which varies each year. You'd need to look that up. I don't think the rates have actually been launched for the current tax year, if I'm correct on that. But you can look up on HMRC website, see what the deemed interest rate is, and then obviously you have to work out at their marginal tax rate how much that would cost them in tax, if that makes sense. So there's no actual upper limit. And yeah, I think we've covered that on our interest-free loans available to directors. The answer to that is no, for the same reason as you can't do that for a close relative.
That's good. Just to pick up on one in relation to the trivial benefits. So why do you recommend maximum trivial benefits of £300 for employees? HMRC doesn't set any annual limit. That's correct in terms of employees. They don't literally set an annual limit. I think the key point is that it is meant to be trivial benefit. It's not meant to be significant. And I think from HMRC's point of view, they would be setting that £300 limit for directors in the anticipation that you might say that's where it might be abused. So that's where it might be, people will be pushing the boundaries. So if they're saying that £300 is the limit for there, I think you'd struggle to then justify that employees could be taking home much more than that without that being classed as part of their earnings, so part of their regular income.
That's good. And there's a question as to the mileage rate for cars. So that's where the employee owns their own car and is obviously using it for business. Obviously, that's 45 pence a mile for the first 10,000 miles, and then it drops to 25 pence per mile over the 10,000 miles. So the question is there scope to pay a member of staff more than that, Jack?
So you could pay them more, but they would be taxed on it, is a simple answer. So in reality, it's then just going to be classed as their earnings. So you're best to just stick with the 45 pence.
Yeah, agreed. And also, obviously, we are aware that that is really out of date, that figure. It ought to be increasing, in our opinion, but obviously at the moment, HMRC are not increasing it. So it's unfortunate.
Yeah, and just pick up one, just in relation to vehicles and fuel, and there's a couple here. Is fuel benefit for vans worth doing where there is no business mileage? So where someone's got a van and they're doing purely private miles, yes, is the simple answer. The fuel benefit for vans is very low. It's not like cars, so it would be worth it in that circumstance. But just for cars, it's not as beneficial. And then on the vehicles, can a pickup have 5 seats? So referring to double cab pickups there, The simple answer is it is classed as a commercial vehicle as long as the payload is more than a ton. So there is some small technical detail in relation to ones with hard tops, which is probably worth a separate conversation if that's the case. But broadly speaking, as long as the payload is more than a ton, it is a commercial vehicle.
That's helpful, Jack. And also just on the question that you've covered off already, where there's no business mileage, you just need to be a little bit careful on that. Even if it's a commercial vehicle, let's say a double cab pickup or a van, please make sure there is just some business mileage. Otherwise, you might find a VAT inspector will disallow reclaim of the VAT. So to reclaim the VAT on the purchase price and also repairs and everything, you need to just have a small amount of business use. Just something to be aware of, particularly if you've got a VAT visit coming up. Please don't be too quick to say there's no business use at all. You could incur some quite large VAT payments. So we've got time for just one more question. I think it was around the medical treatment piece that you spoke about, Jack. My employee faces urgent medical treatment. Can I really pay for this through my company?
Yes, good. Yes is the answer, but you just need to make sure that you are involved in both arranging and that you pay direct for the treatment, and then you report it on the P11D form. It is quite important that you make sure you get that right and perhaps take advice at the time, just because if you get it wrong in terms of who's arranging the treatment, who pays for it, whether you reimburse the employee, you can then it has to be very specific, otherwise it will get put through the payroll and they'll be taxed in that way, so they'll pay national insurance as well.
Very good, that's helpful. And that concludes our event. We'd like to thank everyone very much for joining us today on this webinar and for your contributions in the form of questions. Apologies that we didn't quite manage to answer them all. But please be in touch. Put the contact details there on the screen for us. So please be free to be in touch with any unanswered questions. And we now conclude. Have a great day, and we look forward to seeing you next time. Thank you.